I mean, I remember a 5-year New Zealand dollar bond from McDonald's at a 12.5 coupon, a
Jeez.
5-year bond.
Wow.
So it was a play on the currencies, but the actual point, it was one of the best deals I ever did, quite honestly. But one of the point of that was, at that time I was with Shearson, and you could call the head of the trading desk and have direct conversation with them. Mm-hmm. So I spent about 1.5 years every morning talking to the head of currency trading at Shearson. And it was, so I'd go home at night and I'd study. And then in the morning we would have that conversation. And honestly, and it was only available for about 1.5 years, because then after that, you couldn't do non-dollar denominated bonds. They put them in mutual funds. And now all of the income from it, we were getting about 25% between the coupon and then the exchange rate. Wow. So that was on a 5-year AAA paper. That was pretty nice. But when Wall Street saw that, they're like, oh, heck no, that's our money. And then the deal was not as sweet, though still a lot higher than what you're getting, right now. And these weren't junk bonds. Up until 1927, all central banks had a lifespan typically between 15 and 20 years, because governments knew that they would end up destroying the value of the currency.
Right.
But so the Federal Reserve in 1927, and I don't think that that's a coincidence either, mind you, was the first time that any central bank had an unlimited charter. Unlimited. It's ridiculous. And further to your point, when they set this whole system up, but let's go back to 1971. The average wage then was $9,500. And one wage earner, a family of 4, could live on that. I'm not saying they were ultra wealthy, but they only needed one wage earner to do that. Mm-hmm. Today, I think the average wage is like $53,000. So most people will go, well, wow, I'd much rather have $53,000 than $9,500. Well, yeah, except you need 2 wage earners. You're still paycheck to paycheck. And look, anybody under $75,000 a year got that $1,200 stimulus check.
Yeah, right.
Right? You see the point?
And they're paying higher taxes because the tax brackets haven't gone up at the same rate as inflation.
Right. I mean, it's genius, because the government and the central banks create this inflation, and then they get to tax it.
Yeah, right.
And inflation is really an invisible tax on your wealth and your working. So, when you talk about the income inequality, it was enabled because of that nominal confusion, right? Mm-hmm. No, 53,000. Wow, I'm doing pretty good. No, you're not. You're really not doing pretty good. But what is inflation based on? It's goods and services, right? So corporations make more money. They pay their employees, the average employee, less. That enables more for the top. And then the further financial engineering with the stocks, and then the stock buybacks and the warrants, right? So part of the package, you got your salary, then you have all of these stock options,
right,
which enable you to buy stock at a certain price within a certain period of time, and then, we see it all the time where a company will come out and talk up their stock, and then the insiders, the high guys that have all those options, exercise those options and sell their stock, and they capture all that money and go out and buy hard assets. In reality, I don't know if they really even care about the P&L, because who's really responsible for their balance sheet? Taxpayers, you and me.
Yeah.
We're responsible for any losses of the Fed. Boy, if they were responsible, if they really were looking at their P&L, look at all the garbage and the legacy derivatives that they have taken off the bank's balance sheet just since 2008. You know, I wouldn't have known any of this had I not done that, talk to that the head of currency trading at Shearson, quite honestly, because that really set me on a path of studying currencies and looking at repeatable patterns. These are things that happen every single time. Obviously, gold has been money for 6,000 years because of its full utility, but silver as well. So, but it's for a different function. So I created, which is what we executed ITM. I created a strategy for myself before I even got there in 2002, based upon those repeatable patterns, because I don't know, history repeats itself.
Right.
And what I think everybody needs to do is have a plan where you're looking at what is it that you are trying to accomplish. For me personally, I'm almost 66 coming up, and I have children and I have grandchildren. So I want to make sure that I have income that I cannot outlive, right? Number one, right now, if everything is in the fiat markets, they're telling you, well, at 87, you're out of money that's based on ideals, but you want income that you cannot outlive. And then because of where we are being led by the nose, it's so important for me personally to make sure that my children and my grandchildren and my great-grandchildren retain choice and retain freedom. So leaving a legacy for me is very, very important. So I created this strategy based on those repeatable patterns, and you look at what you're trying to accomplish, and then you say, okay, so what functions do I need to perform? One of the things that we all need to do is sustain our current standard of living. And that means that when that money is disappearing from your account or the prices are going through the roof, either way, then you want to still be able to go out and buy that box of strawberries or put that tank of gas in your car when the currency is no longer trusted. And that's really where silver comes in.
Right.
And pre-65 is 90% silver. So you've got dimes that are a tenth, roughly. They're not quite 3/4 of an ounce because they're 90%. But just to make it simple for people overall, you know, a dime is roughly a tenth of an ounce. A quarter is roughly a quarter of an ounce. A $50 is roughly a half an ounce. And a silver dollar is roughly an ounce. So you have different sizes because during this period, change becomes irrelevant.